Hello everyone. Let us understand the concept of balance sheet from examination point of view. Till your induction, what you have learned is preparation of balance sheet from basic transactions. We must have started with a sole trading concern or a partnership firm. To understand the transition from sole trading concern to joint stock company in terms of accounting as well as preparation of balance sheet or revenue statement, it is absolutely important that you first understand what is a sole trading concern, what is a partnership firm, and what is a joint stock company. This video will help you understand this basic aspect. When we look at a sole trading concern or a partnership firm, what are the common features that we observe? A sole trading concern is generally one person controlling all the affairs of the business. So the capital invested is less, the risk undertaken is huge. Of course, you get a huge secrecy aspect. Your business secrets does not go out, and you are in control of the management of the business as well. But definitely the most negative aspect is you have an unlimited liability where even your personal assets are always at stake. To overcome all the shortcomings that a sole trading concern and a partnership firm had, a new form of organization was introduced, that is a joint stock company. Now, what happens in joint stock company? This company is formed in four stages, wherein the ownership remains with the shareholders and management is done by the board of directors. So, this basic aspect differentiates a joint stock company from a sole trading concern partnership firm. While there are a lot of advantages like specialization, huge capital, limited liability, but there is one major disadvantage that this aspect has, and that is since the money is of the shareholders, there is a probability that it may be misused. The directors may use it for personal benefits. To keep a check, we have Companies Act 2013 that controls the overall preparation, recording, as well as every aspect related to a joint stock company. Let us have a feel of how the things have changed. Till now, whatever balance sheet you had prepared, there were basic headings that were defined, like the non-current assets, the long-term assets of the business, the current assets, the short-term assets of the business. Owned funds represented the capital invested either by the owner or the sole trader. It may even, in case of partnership firm, you may find two types of capital. Borrowed funds could be loan taken from bank, from any relative, or from an NBFC, and likewise. Whereas the liabilities which are payable within 1 year are called as current liabilities. In the induction, it is expected that you might have prepared balance sheet of a sole trader. Now, what changes happens when it comes to a joint stock company? Let us today just get a feel of it, and in my next video I will explain each and every item. In a balance sheet of a company, what happens is the items, the headings which are to be included in non-current assets like property, plant, equipment, capital, work in progress, goodwill, other intangible asset, long-term loans, long-term investment, deferred tax asset, and other non-current assets. This is defined. Likewise, among current assets, we have inventories, trade receivable, cash and cash equivalent, short-term loans and advances, and other current assets. So, in a sole trading concern partnership firm, what was defined very clearly was only the heading. Here, what is defined is the subheadings as well. Likewise, the word capital gets replaced by equity. The long term borrowings that now gets what we call as replaced by the term called as your non current liabilities, and then you have current liabilities again defined. So in my next video we will learn more details about the assets and liabilities that I shared. Have a nice day.